Good morning, you're watching One News Now Markets. I'm Danny Laurel. Now, before we delve into the equity space, here are the top stories of the hour. Finance Chief Ben Diokno says President Bongbong Marcos has approved the proposal to merge two state-run banks, that is the Land Bank of the Philippines and the Development Bank of the Philippines. Finance Chief Ben Diokno defended the plan, saying that merging the two public lenders would result in the country's biggest bank in terms of assets. Diokno also cited the need to strengthen the government bank amid issues in the global banking sector. The merger is seen to save the government 5 billion pesos per year, and it is expected to take effect this year, but so far there is still no definite timeline. Land Bank will be the merger's surviving entity.
By merging the two, it will now become the number one bank in the Philippines. And that's really the best practice. The biggest bank usually is owned by the state globally.
Secretary Diokno also assured the public that no sectors will be compromised by this merger.
None of the services provided by either bank will be lost. And we assured him that with the merger, because both the Land Bank and DBP are universal banks, they do almost the same, right? Except that one is focused on agri, the other one on industrial projects. But they do practically the same.
An official of the Trade Department says the Regional Comprehensive Economic Partnership or RCEP agreement will likely take effect for the Philippines in June. Trade Assistant Secretary and RCEP lead negotiator Alan Getty said the government plans to deposit the instrument of ratification for the country's participation in the mega trade deal by April 3rd. This instrument will be sent to the Secretary General of the Association of Southeast Asian Nations, or the ASEAN. The RCEP will then take effect 60 days from the deposit of the instrument, that's according to Getty. The Philippines was the last participating country to ratify the RCEP. The Senate only gave it concurrence last February 21st due to concerns raised by the agriculture sector. Now, banking sector stability and transparency is still the focus of the markets. Here to weigh in, we have with us Rustine Mercado of China Bank Securities. Good morning, Rustine. Welcome back.
Good morning. Hi. Thanks for having me, Dan.
All right, Rustine, let's kick off with the headline, which is, of course, the merger of the two largest state banks. Why do we need this, and how important is this for our banking space?
Well, I think the main rationale there is, of course, to help streamline operations, right? So you have the thrust from the government where they're trying to right-size their operations. So I think it was mentioned that the merger would save around 20 billion in the next 4 years, right? And then you also have some assets that would end up redundant. So there's the office space, but I think that also translates to some manpower reduction,
okay,
right? But generally, you're also seeing some consolidation in capital, right? So you're given the mandates historically of your Land Bank and DBP, Land Bank really more for agri, and then DBP more for industrial, having a wider capital base spread across both when the merger is complete, just make sure that that capital, that ability to loan out is being deployed to sectors that really need it the most.
Okay, but they're doing this because, well, according to Secretary Diokno, because of recent financial developments abroad. What exactly does this mean?
Well, I mean, our regulators, BSP, has mentioned it. We have a relatively resilient banking system, right? Mm-hmm. So I think this is really just to make sure that you consolidate capital. And of course, I think it's just getting ahead. They're trying to build confidence. Of course, that has been taking some hit, even though we're resilient, right? So I think it's really more of just making sure that they're ahead and making sure that when the opportunity does arise for loans to be deployed, then you have a wider capital base that you can source it from.
Okay, now let's talk about the banking sector, at least offshore. More woes coming in, particularly from Europe, Societe Generale, BNP Paribas probe. Is this related to those things in the US and Credit Suisse, or is this a completely isolated case for these two banks? Should we be worried about these types of probes?
I think, of course, the probe is issue specific, right? I think that has something to do with some taxes, but I think the main risk here is that it really doesn't bode well for investor confidence, right? You've seen that take a hit over the past few weeks, and I think at this point you're seeing investors still think risk off. You're seeing a great deal of disinterest in the market. Your trading volumes aren't up to where they are. It's for us, right? And we're supposed to be relatively recent already, right? So I think that's the main risk, right? For the US, you had some bank runs leading to the collapse in SVB. So that has more to do with confidence, right? So I think it would be a harder path to take in terms of rebuilding confidence for regulators if you have issues like these hounding your banks.
So parang nagsabay-sabay lang talaga in terms of these issues coming to light. I want to ask, Norestine, how are we doing compared to, I don't know, the rest of Asia, the rest of emerging markets amid all of these, let's say, financial sector woes?
Okay, so I think in terms of fund flows, right, we're generally in the same boat. We've been seeing those outflows. I think from the beginning of the year, we did see that interest that came back in. We had foreign funds coming back in up to, I think, February. And then you had them kind of flowing out at a strong speed come late February to March, and the market did sell off. But I think it was because, of course, heading into this year, we had great prospects, right? You had growth continuing still. You had easing inflation, right? In terms of outlook, that was there. But inflation proved to be sticky, and that kind of eroded confidence, right? So you're seeing some risks still with inflation, and then you have this, right? The banking sector woes, at least in the US and Europe. So I think at this point, it's really the confidence. Again, I keep on saying confidence amongst investors, but really that's the case, right? I mean, even if we're at valuations that are fairly low already, right? Convincing investors to buy assets or buy risky assets or like equities, for example, pushing prices back to where they were just a few months ago is really going to take some convincing, right? And if they don't have that conviction, if they don't have that confidence, then it will be hard to get back to those levels.
So sentiment-wise, like you mentioned, there's some sort of contagion when it comes to sentiment. But what about our domestic issues, especially when it comes to the last action of the Bangko Sentral and their wording here? You've got Secretary Diokno saying that we might be pausing on the rate hikes because the BSP has done enough. But then you also, like you mentioned, said inflation continues to be sticky. Which side are you looking at here when it comes to the rates? Have we reached the peak of inflation? Have we reached the peak of rate hikes?
Well, I think in terms of rate hikes, we're obviously seeing the hiking to be concluding fairly soon, right? In terms of market expectations, I'll talk about offshore first. So for the US, they're seeing another 25 bips, but market expectations are now looking at a cut somewhere in the second half. That's contrary to what the Fed is saying. So I think, and then you're seeing markets still weak, even though expectations have shifted towards that. So I think what that underscores really is your markets are moving away from focusing on policy rates, and they're really focusing on the drag on economic activity that, of course, is going to be much more dragged by what's been happening in terms of credit for them, right? For us, in terms of inflation, hopefully you've seen the peak, and I think that's the case. And the BSP kind of nearing the end of its hiking cycle is actually is in a good space where the spread between the US Fed and us is fairly large, and and we're comfortable with that. So I think that bodes well for us. It also gives the BSP some space to see where the economy will be, but generally you're still seeing that consensus of growth for us given prevailing headwinds, right? So that in itself should be a good sign for our domestic companies.
You mentioned, the impact of inflation in terms of growth and also possible, recession here. We have a couple of earnings that came out this morning and also yesterday. And can you give us more ideas on the consumption space? Let's kick off with Pure Gold, which actually had net income up 13% year on year for 2022. That was above the estimates, at least of Bloomberg. Give us an idea of your outlook on this stock in particular when it comes to consumption in this high rate environment, high inflation environment.
Okay, so Pure Gold compared to consensus, compared to our own estimates, they were slightly above, and that was more to do with top line. So that top line growth really is because of consumers becoming more mobile. You have back to return to office, you have back to school, kind of propping that up. And of course, Pure Gold, there's a lot of sari-sari store owners that source from them. So having that mobility back 100% is something that provided tailwinds to that, right? In terms of consumption this year, you're seeing a mixed picture. Some companies are seeing those challenges come in. Your telcos are seeing that hitting consumption for data or consumption for legacy services. But then there are some parts of or some industries that are seeing strength, right? I think moving on to SEB, you're seeing that recovery slowly getting in there in terms of on a quarterly basis. There has been improvement. I think in terms of an operating loss, they have managed to bring that down from the 4.23 billion mark to around 200 million for the fourth quarter, and they're already a bit positive. So with the outlook for improving volumes in terms of passengers, recovery, international travel, that should continue to improve this year, right? So that's a stark contrast to what their telcos are kind of experiencing, and I think that just underscores how fragmented or how the growth story and recovery is going to be disjointed for some of your industries, right? Of course, we're looking at consumer spending potentially slowing down, so we're a little bit more cautious when it comes to retailers. But I think in terms of margins, they're able to maintain those quite well.
Yeah, just one last point on Cebu Pacific since you brought it up. Your outlook on this sector is despite consumption going slower, people are continuing to travel. Is that correct? How is that possible?
I think they're also enjoying some pent up savings being deployed into traveling. We're seeing discretionary spending still a little bit upbeat, at least through the fourth quarter and through the first few months of this year. But I think, of course, with the situation as it is, right? I think with what happened to the banking sector in the global banking sector in March, even if we're not affected or we're resilient, right? You're gonna see some people paring back their plans, right? But I think really it's just that in terms of that pent up savings being deployed, we kind of lag the rest of the world. And you're seeing some benefit to some sectors there. In terms of consolidated earnings, we generally saw beats and misses in terms of full year, right? So we ended the year quite strong. And the outlook for this year, upbeat in the first few months, at least for those that reported earlier. Obviously, that might change come the first quarter. So a lot of them are actually delaying updating guidance after their first quarter earnings results, right? So I think that just underscores how the fluid situation now is obviously to us as consumers. We're trying to navigate that, but even more so for businesses.
All right, and finally, one sector of interest now, which is renewable space. We just had the first IPO of the year, Alternergy, and now we have MPIC buying into Solar Philippines. Give us more color on whether this is something that we should be looking at in terms of a stock, or is this a long-term play? Is there really going to be value unlocked for a company like MPIC?
I think the solar, the renewables as a story is a long-term play, right? You have capacities that will be coming up. It's mostly going to be renewables. You have that moratorium on new coal plants. So it's really going to be renewables driving the supply for our energy requirements. So for MPI, I think that's a good move because it further diversifies interest and, of course, enhances its sustainability agenda. For shareholders of, I think, both companies, right? Specific to SPNEC, right? Provides capital to the SP Group to continue building out its capacity, right? That's what the proceeds for the share sale would be used for. And then, of course, it also provides SPNEC with the experience and the synergies coming from the long-standing major conglomerate, which is MPI. For MPI, it's also another foray into another business, or at least enhancing that business. And it's really capitalizing on growth where it's strong. And definitely the renewable energy space is something that we're seeing exponential growth in over the coming years.
All right, checking in on SP NEC this morning, trading at 1 peso and 78 centavos, up by 2 and 3/10%. Thank you so much, Rastine Mercado of China Bank Securities, for your insights today.
Thank you for having me and have a great week ahead.
And that's it for this hour. I'm Danny Laurel. Join us again at 11:15 a.m. We are One News, all sides, all the time.